What's up, everybody? Today we are analyzing Apple stock, and I have it pulled up here on TradingView. Let's check out the 5-year chart. We can see that it has gone from about $50 a share up to $170 a share over the course of 5 years. So very, very strong performance in comparison to the S&P 500, which is up about 90% over those 5 years. All right, we can see the market cap here at 2.64 trillion and its price to earnings ratio of 26. If we scroll down a little farther, we can get a good look at their revenue growth for the past 5 years. And we can even see quarterly, their last quarter, Q1 2024. It does seem like this is sort of cyclical because Q1 of 2023 was also a very good quarter. And it looks like the net margin is hovering around 25% every single year. What else can we find? Let's go to financials. Let's go to their statements. Let's check out their revenue growth from 2017. Looks like up 6%, 16, and then actually down, and then up a little bit, and up a lot. All right, so it kind of looks like Apple might be a cyclical business. It really has to do with the economy and how much money the consumers have to spend on Apple products. It also depends on what types of products Apple has come out with for that year, and maybe some people don't want to upgrade, or maybe they do want to upgrade when that new thing comes out. What else can we see here? Their net income has been rising along with their revenue. Their shares have been decreasing a lot. They actually buy back tons and tons of shares, so that's how they return shareholder value. Let's see their balance sheet. It does look like they have a lot of assets and a lot of liabilities. Let's check on a quarterly basis. They have net debt of 35 billion. So they have a lot of cash because their total debt is 108 and they only have 35 billion of net debt. Book value per share is, of course, way, way lower than the stock price. Let's check out their cash flow statement and see what they're doing with the returns. Free cash flow should usually track pretty well with earnings, but let's see what they're doing with their cash. Looks like they are buying back lots and lots of stock, about 80 billion a year, and then the total cash dividends paid is 15 billion per year. So they're buying back a lot more stock than they're paying in dividends, and that is for sure. Let's check out the stats page and look at the most relevant statistics for each business. Here we can see the net margin of the business, 21, 22, 20, 25. It looks like it has been rising over the years. Let's check the ROIC, return on invested capital, very important metric. Looks like that has risen as well. It's all the way up to 62%. Very, very strong for Apple. Now, I want to see what their... Okay, here, let me zoom in a little bit here. We can see that they made most of their money through iPhone sales. And iPhone sales are up by about 4 billion over the past year. iMac sales are flat. iPad sales are down, actually. Then we have wearables are down. So even with that new headset, looks like the wearables are down, or maybe that will show up in the next quarter's earnings. Then we have services as well. Services are up, and in total, their revenue has increased by about 2 billion. Let's check this, and we can see their net income has increased by 4 billion, so strong increase there. It's about 12%. And so I actually ran a compound annual growth rate on Apple's revenue, and this is what I came up with. The compound annual growth rate of Apple's revenue has been 9% in the past 6 years. And then we can also check out analyst forward projections. Here I have the analyst's opinions for their growth estimate. Here we have 6.56 per share, and then the year after it jumps to 7.16, or about a 10% increase. Then also with revenue at 388, and then revenue to 413, which is what? That's not that large of an increase. It's probably like 7 or 8%. So I plugged these numbers into my discounted cash flow model, and here is what I found. Let me zoom you in. Here we have Apple. We have the EPS estimate, the revenue estimate, and the net debt. Discount rate that I'm using is 10% because I expect to get a 10% return on the stocks in my portfolio. The exit multiple I have at 22 because Apple is a high quality business with a large moat, and I believe that it could grow a long way into the future. All right, now we have earnings growth. So we use the earnings estimate for 2024 right here, and then our earnings growth going into the future. Now, maybe this isn't accurate. Take these numbers with a grain of salt. This is just my opinion on their growth. And I do not think that, well, okay, they can grow, but they're already in a heavily saturated market. And they're already one of the biggest companies in the world. So that may limit their growth going forward. Here, their growth, I just put 9% for the next year and then just slowly declining down to 5% a year going forward. Now, 5% is still over inflation if inflation is at 2%. So I still believe that that is strong earnings. And we can see that using the discounted earnings model, the fair share price using this discount rate is $143 a share. We can also do the same thing except with revenue and margins. Now, if you remember, the revenue growth has been quite slow. The revenue growth estimate was actually about like 7 or 8%. So let's use 7% for that year. And we can see that using these revenue estimates and then the profit margin at 28% and then expanding up to 32 and staying at 32, the fair value of Apple is $160 a share at a discount rate of 10%. Now, if we want to move our discount rate down a little bit to maybe 8%, maybe we'll expect an 8% return for Apple. And we can see that if we use a 8% discount rate, expecting an 8% return going forward for Apple, that a fair value would be $160 or $180 in this case. So that would be my opinion of Apple. I think you're going to get about 8% returns going forward. And that's why I am not super excited about this stock. If you guys like the video, please hit that like button. I really appreciate it. If you really enjoy, hit that subscribe button. I'm doing lots of these analysis videos. And I'll see you in the next analysis.